All right, a very warm welcome to This is My Chat with a Bank CEO, a series of conversation that we will be exploring what is currently happening in the banking sector here in Kenya and essentially what is the entire industry pulse, where is that at? And we'll also be exploring some of the major topics that have been making headlines here in the country and just looking at it from a banking and financial perspective. This is the very first in a series of conversation that we'll be bringing to you for the next 5 weeks. So you better stay tuned, follow this conversation. We are live on X, we are live on LinkedIn, we are live on YouTube. That's where you can follow this conversation at Kenya Bankers. That is at Kenya Bankers. That is the handle on X, and at Jim Cario is where you can find me. And today's conversation, we will be joined by Jubril Adeniji, who is the Managing Director, Guaranty Trust Bank, or if you like, GTBank here in Kenya and the region. He's had an experience across East Africa, an experience across West Africa, and he's here to share some of those insights and some of the things that he has learned across the different markets. The topic today is looking at loan repayment history, why it matters, and how it can save you money. And also send in all your questions, and we'll be sure to sample them as we continue this conversation. Remember to stick on the topic, loan repayment history, why it matters, and how it can save you money. Now, Mr. Jubril Adeniji is a seasoned banker with over 25 years experience. He's had stints in banking, in credit and business development, in multilateral construction, oil and gas, and just to mention but a few, he's also worked in East Africa, as I earlier mentioned. He's worked in West Africa, and he's here to share with us some of the insights that he has been able to pick across the different markets. Mr. Jubril, good morning.
Morning, Jimmy.
You well?
I'm good. And you?
Wonderful. I'm perfect.
Okay.
Looking forward to this conversation.
Same here.
But first, I want to give you an opportunity to just make your opening remarks, and then we'll pick it from there with a couple of questions.
Opening remarks. It's a pleasure to be here and to share my thoughts around activities and occurrences within the Kenyan banking environment,
Yeah.
East Africa and Africa as a whole. So thank you for having me, Jimmy. Yes.
Wonderful. And for those of us who are following this conversation, the hashtag to use is the CEO chat. The CEO chat. That's where it will all be happening. Remember to retweet. If you hear something that you like, feel free to caption it and continue to enjoy the conversation. Now, Jubil, our conversation today, we're just looking at loan repayment and
Sure.
why it matters and how it can save you money. But the first thing that I want to know from you, you've been in the banking industry for over 25 years.
Yes.
Let's start from the beginning. Have you ever had a loan? Do you remember what your first loan was for?
Sure. It was to buy a car. Because, when you start off your career as a young individual,
Yeah.
first thing is you want to be able to move in and out of work as swiftly as possible. So when I started my career, of course, I didn't have a car initially, but I realized it was an important tool to have. So my first loan was a car loan that I took from the first bank I worked with.
Yeah. And
Yes.
how long did it take you to repay that loan?
Well, I think I repaid it in a very short time. I'm not an individual that really likes to take a loan. So I only had to take it because it was existential, like I mentioned, and it was important for me to start off a career at the pace at which I wanted to start it off. So if I remember, I would say I paid it back maybe in about 2 to 3 years.
Yeah.
Yes, because like I said, I did not want to keep a loan, but I needed it because the capacity to afford a car as a young professional was not there. So, but one thing I also did was to ensure that I had an equity contribution to the purchase of that car. So that really reduced the impacts of the repayments on myself. And it also ensured that I had a skin in the game. How do you want to own an asset without having a skin in the game? That is still surprising to me.
Yeah.
Yes, but in today's market, in this market, I see adverts out there 105%. How do you finance someone 105%? So what's the person's commitment to the transaction?
Yeah.
Questions left to be answered. Thank you.
Okay. Good perspective that you bring out there. And so now that you're on the back end of this transaction, you are sitting on the other side of the bank, coming up with strategies and looking at how to price based on risk. I mean, here in Kenya, the big conversation right now is on Kesonia and risk-based pricing model. And I want to know, what are some of the metrics that you think banks are looking at to be able to determine this is a good customer, this is a risky customer, and how then can I improve my standing with the bank, that whenever I show up seeking a loan, then I will be able to get the quality of loan that I need.
Okay, thank you very much, Jimmy, for that question. I would respond by starting off with the 5 C's of credit. I believe you must have heard about it before, and those are guiding principles around credit, which is tied to both a borrower and the lender. And the 5 C's of credit starts with character. That is the most important C of credit. Then, after character, then you have capacity. From capacity, I will talk about capital. Then, collateral. Most people treat it in the reverse, thinking collateral is the most important criteria to granting a credit.
Yeah.
And lastly, condition. So going back to your question, the first C's of credit and the most important C of credit is character. And that is tied to how you have repaid a loan before. What is your credit score? So I'm saying this to listeners today, that please, your credit profile is the most important feature or criteria that a financial institution will consider in the course of trying to grant you a credit.
Yeah.
So if you take 1,000 shillings loan, please repay it. As you repay it within the timelines that you've agreed at commencement of that credit, it gives you a positive notch in your profile.
Yeah.
And as you continue to do that, you start building a very positive profile. And that's why you will see that when you go to a bank today, your profile is checked on the Credit Reference Bureau to say, what is Jimmy's profile? And the stronger your profile is, the higher your score, and the greater the probability of you getting a loan from a financial institution. You have also linked it to where we are today in Kenya.
Yeah.
The risk-based pricing model has been introduced. We are all at the point of trying to put the models in place, secure governance approvals, and also ensure that in the course of that going on, we are able to price risk appropriately.
Yeah.
You will be priced based on your profile. So this takes me back to, please pay your loans appropriately. There is no perfect loan. You can start off a loan today, assume you will pay it within a fixed period of time. However, some situations occur that are out of your control. The most important thing for the borrower is to step up to your bank before your bank step up to you.
Yeah.
And say, this is what I can foresee. And the moment you do that, I can assure you, Kesonia is the benchmark going forward in the Kenyan banking industry. But you see, it is Kesonia plus.
Yeah. Risk premium.
Some people will borrow Kesonia minus. Why do you think they will borrow Kesonia minus? It's because they have built a profile, and with eyes closed, you can say that individual, that entity is a strong borrower. Let's borrow at the lowest rates, because the risk premium we are carrying or we need to add to that transaction is virtually non-existent.
All right, and that's a good point, Jubril, that you bring out, because the conversation that we've had in Kenya for the longest time is borrowers with good credit history say they're yet to experience lower interest rates. And I really want to know, in terms of determining the amount of interest that is going to be charged on a loan, what then is the thought process? What thought process do banks then sit back and determine and use to say that, okay, we've seen Jubril, we've seen his credit history, let's now price him at 10%, at 5%.
Okay, thank you very much. The greatest positive that is expected to come out of the new risk-based pricing model
Yeah.
is that Jubril is going to be priced different from Jimmy, and that is tied to my credit profile.
Yeah.
So banks are going to risk rate every borrower going forward, and in the course of that risk rating, you can either be at the highest level of 1,
Yeah.
which means I can lend to you at the lowest ever rates you can find. I can lend to you without collateral, 0, and you will get the best pricing in the market. And it's because you've built a very strong profile. However, if your risk rating now starts getting to 4, 5, 6, which are the least acceptable risk rating for lending,
Yeah.
please be rest assured that the probability of default at risk rating 4, 5, 6 becomes very high, and that now requires the bank to add a much higher premium
Yeah.
to your borrowing rates.
Yeah, which brings me to my next question, Jubril, is
Yes.
so how then can banks balance between strict credit scoring models and supporting customers who the main reason that I'm getting this credit at this point is because I'm stuck somewhere.
Okay. I do hear you. You're stuck somewhere. But if you step into a bank as a first-time borrower,
Yeah.
you will be appraised as a first-time borrower because you don't have a history. And in as much as you don't have a history, it becomes very difficult to price you without going through a standard model. Because if you don't follow that model, then it will now be pricing you based on perception. Oh, I like the way Jimmy looks,
Yeah.
so I will price Jimmy at 15%. I don't like Jubril's face, I will price him 19%. Then objectivity, transparency is off the table. So the risk rating model that we use as banks will look into: are you employed? What's your source of earnings? Who is your employer? Have you borrowed before? What is the history when you borrowed? Do you have capacity to repay what you are asking for? Do you have a commitment in the transaction? You walk up to me, you would like to buy a car.
Yeah.
And I say, I have 50% of the cost of the car on the table. That gives a banker a very positive perception to that transaction,
Yeah.
because that means you have planned, you have realized that you need to be part of the transaction, then it becomes easier for you to be priced.
Yeah.
Yes.
And I've heard you mention the employer, and the question that I have in mind is, does my employer's credit history then affect my ability to get a loan?
Very, very important, because, and I would speak to you as Jimmy individually.
Yeah.
Let's assume you work for a top rated entity in Kenya today. What that's the leverage that gives to you is that we look at the macros and we realize that, okay, irrespective of how bad or how tough
Yeah.
things get, this institution will stand the test of time. I'm sure we all can still remember COVID.
Yeah.
Risk rating 1, risk rating 2 entities never laid off one employee. Guaranty Trust Bank Kenya Limited, all through COVID, never laid off one employee. However, as the market got tough, a lot of mid-sized institutions,
Yeah.
first point was, how do I cut my costs in order to be able to survive? Because survival becomes the most important factor at that point.
Yeah.
And for you to survive, you start looking at what are the excesses and you start cutting it off.
Yeah.
So in answering your question, 100% the profile of your employer affects your risk,
It affects you
your
directly.
risk rating. Yes, please.
All right. So for a customer who has defaulted, maybe I was running a business. In the course of my running business, I ran into some headwinds. I was unable to repay. Now I've been rated as a defaulter. How then do I repair that credit history?
Okay, thank you very much. Like I mentioned earlier, don't wait for your bank to come to you as a borrower. You proactively prompt your bank because you see the business on a day to day. You can see that things are getting tough. You walk up to your bank, you are able to put facts on the table
Yeah.
to convince the bank that this is not that I have diverted money into needs that I don't require,
Yeah.
but it is based on practical challenges in my business, which I can prove. I took this loan in order to repay it in 2 years. Based on the cash flow and the projections I had, things are not working like I had anticipated. I would like us to discuss and agree on how to manage the situation.
Yeah.
That way, that earns you an additional positive score. Or I run into a challenge. I can see that I am over leveraged, which means I have borrowed beyond my capacity, which every borrower should avoid. Don't take beyond what you can afford to repay. Because the challenge with a loan most of the time is the repayments. When you're taking the loan, there's excitement on the face of both the lender and the borrower.
Yeah.
But the pain only comes when it's time to repay. You must anticipate that time. And when you get into such tough times,
Yeah.
looking around and saying, see, I took a loan, I'm in this challenge, but I want to solve it. I have that asset. I believe I don't need it today. I'm putting it up for sale in order to reduce the volume of the debt.
Yeah.
That brings a lot of positive to the table. And therefore, the bank starts listening to you better, and you're able to try to restructure that transaction quite easily.
And speaking of restructuring, the perception in the market is that when I go to a bank and I tell them I have this facility that I need restructured, their perception will be that this is likely to be a risky customer, and that has a negative impact on my credit score. So, from a banker's perspective, is that assumption correct? Is that fear sort of true from what you've seen, or do customers just need to walk into their banks and restructure their facilities at the beginning of the time that where they start to feel that this is becoming risky?
Okay, thank you very much. Transactions are different and they would not all work the same way because whatever you are doing is also related to the macroeconomic environment within which you are operating.
Yeah.
Therefore, I would encourage borrowers to please feel free to walk up to their bankers when they have challenges. Yes, as a banker, when a customer walks up to you and the point is, oh, sorry, it appears something is not working well, I will try to us to have a second look. Yeah, you will feel immediately, oh, okay, something is about to go wrong here. But that does not mean you will not give a listening here.
Yeah.
You will give, and yes, it might affect the score of that borrower, but I can assure you, when you come back and say you want to borrow again, the bank will still give you an opportunity because you looked for the best way of addressing the challenges in the course of trying to repay the loan. So please, I would say, walk up to your bank freely when you identify a challenge ahead of the bank,
Yeah.
observing, and walk through it and put a very reliable repayment plan on the table. And like I said, please show commitment. I am meant to pay 20,000 every month. I am unable to pay it today. But for me to ask for a restructure, I would like to give you 5,000 over the next 6 months in advance to show you that I'm committed to the transaction, then ask you to reduce my repayment from 20
Yeah.
or reduce my repayment from 20 to maybe about 15 every month, so that way the pressure on me and the business can continue.
So, Jubril, does restructuring alone then mean that my repayment is going to be more expensive?
Well, It's not going to be more expensive. What I think you should have at the back of your mind when you want a restructure
Yeah.
is I need my business to survive. I need to maintain my credit history, and I need to ensure that the business itself can take the values that was expected ab initio in the course of trying to take the loan.
Yeah.
But in terms of costs or it being more expensive, I don't believe success is cheap or you can get through life without committing.
Yeah.
In the course of asking for a tweak in the structure of your transaction, it is the value that you should be looking up to and not, okay, I'm having to pay more. You're having to pay more because you have asked for an extended prepayment period.
Yeah.
The day you were going into the contract, the assumption was you would repay in 2 years. Now repayment is going to be 5 years.
Yeah.
Mind you, the bank was anticipating repayment and collection of that deployed capital. It's not going to come as quickly anymore.
Yeah.
It would come with some costs.
Okay.
Yes, please.
Okay. And just, I mean, drawing from your experience within the region and even in the West African region, when you look at the process of restructuring these facilities, how easy or how difficult is it?
Okay, thank you very much. Like I mentioned earlier, transactions are different, situations will vary in the course of trying to approach a restructure. If the customer has approached you and has put facts on the table, fundamentals are right, it would require you as the credit officer to justify why that restructure should be approved by the bank's credit committee. Because at that point in time, you're coming to say, oh, sorry, I had come here, painted a very positive picture, but the transaction is not working as expected. But it is not because the customer has diverted proceeds or the customer has used the proceeds of the transaction for some other purposes outside what it was approved for. There are objective challenges. This is the commitment the customer has brought to the table. We believe in the character of this individual, and we think we should walk through this together.
Yeah.
You will be the mouthpiece of the customer at that session. You must believe in it first as the credit officer. If you don't believe in it, there's no way you're going to sell it to your credit committee. And the moment you believe in it, I think it will work. But one thing you should have at the back of your mind when asking for a restructure, the discussion between the borrower and the credit officer is not cast in stone.
Yeah.
That request is going to be taken to a credit committee that is going to look at the transaction, and some changes or additional conditions might come through. And that is why at point of initial discussion, as bankers, we will always say it is an indicative document. It's not a full offer letter.
All right, a question that I'm sure a lot of our audience are struggling with,
Yes.
and this is something that I personally have struggled with, is the question around how long does good repayment reflect on lower interest?
I would say it is a very positive factor in the course of getting lower interest.
Yeah.
But mind you, interest is also tied. It's market driven, and that's why we're back to Kesonia today. So because you see, borrowers always look at it from one perspective. It is the funds that banks have received in the course of deposit mobilization that we unlend to borrowers.
Yeah.
If the funds we're getting come at very high premium or at a very high cost, it becomes very difficult to lend to a borrower at a much lower rate.
Yeah.
And therefore, I would say we compare interest rates in the developing countries with the developed countries most of the time. And the question is, oh, why are you in double digits? In those environments, they are single digits. They are almost at zero.
Yeah.
But when you also go into those environments, deposits are priced at very, very low rates.
Yeah.
So if we get funds at very reasonable rates as banks, and you have a positive history, like I mentioned earlier, you will get a better interest rate
Yeah.
than a borrower that does not have as strong a credit profile like you have.
All right, and just to remind those that are following this conversation, the hashtag to use is the CEO chat at Kenya Bankers at Jim Cario. Those are the handles that you can tag us on, and we'll be sampling some of the questions that are coming in. We're still looking for them, and in the next couple of minutes, we'll start getting into those questions. Now, Jubril, and this is something that you had mentioned earlier, and I just want to take you a few steps back.
Please.
Now, for customers, and particularly here in Kenya, for the number of customers that have been quote unquote blacklisted, when you look at the quantum of the facilities that they have, it's very you would consider that very small ticket loans. But then it has led to a lot of Kenyans being blacklisted and or having a negative credit rating. So how important is it to repay these small loans, and also does it then open the opportunity for me to get an even bigger loan? Or, and how many of these small loans do I need to pay off before I'm eligible for an even bigger loan?
Okay, excuse me. Thank you very much for that question. The perception or the approach banking takes is leveraging significantly on history and experience.
Yeah.
If Guaranty Trusts is a commercial bank in the Kenyan environment, we introduce a product whose primary purpose is to support Kenyans grow. And in the course of trying to deploy that product, it's availed to maybe 10 individuals. Of the 10, 2 pay back, 5 are unreachable, 3 are paying but struggling to pay. Banking is all around risk management.
Yeah.
You will continue to review every product you've put into the market on a regular basis, and trying to observe what are the positive trends, what are the challenging trends we can see. Jubril's credit profile and ability to repay might affect a lot of other people if it is positive, because that means in a group of 10, Jubril and 9 other people paid on time, that transaction structure worked, no diversion, then it becomes easier for 1,000 other people to benefit from that product. But if the experience Jubril and 9 other people put on the table are all negative, then that product to start with will be put to question. What is not working? What have we believed would work and has not? That way, it will affect other people that might even have positive intentions. Yeah. So it's all around the principle of probability. How much have worked? How much has failed? And the higher the probability of default, the lower the appetite to lend as a bank under a specific product or to a specific market segment. However, that will not stop us to continue to play our intermediation role in the market. What that drops on our table is we need to get our thinking caps on again and look at, okay, we've deployed product X. This was how it worked. These were the challenges we observed. How can we tweak this product? Then we tweak it again and try to redeploy it. And if we redeploy it and it works better, then it now becomes the product that we would continue to sell the most. So the better the performance of the product and the features of that product now becomes the stronger features that we would like to sell in the market.
Yeah.
Yes.
So
please.
does having multiple facilities affect my credit rating?
No, it doesn't. In as much as you have not over-leveraged.
Yeah.
Over-leveraging would affect your credit profile because eventually it will affect your repayment capacity.
Yeah.
And that's why as bankers, we must also ensure that we don't take a borrower to a point beyond the capacity of that individual. The moment you give debt, okay, in the environment today, or I would say global best practice in terms of borrowing, is that you should not apply more than 1/3 of your disposable income to loan repayments.
Yeah.
But we've pressured the system extensively that we are even at spending 70% of our disposable income
Yeah.
to servicing a facility. When you get to the point where you don't have disposable income anymore, what comes into the mind of the borrower is, how do I default? Because you have basic needs: accommodation, family, education, power, water. When you can't meet those basic needs, the question is, oh, who is the bank?
Yeah.
I need to survive first. So my advice again is, please, at every point in time when you're going to take a loan, only take what you require and don't over pressure yourself. The moment the pressure becomes too high, then the probability of default becomes
even higher.
yes, becomes inevitable.
Yeah.
And the moment you get to that point, it's going to affect your credit history. It's going to affect the credit accessibility for other people, because you become one of those additional defaulters on the table, and a proper financial institution will start learning from that experience.
So I want to throw a scenario at you, and this is in regards to joint facilities. Jubril and Jimmy went and got a facility that maybe for whatever reason we were not able to repay. Does that then affect my evaluation as an individual?
Yes, because Jubril and Jimmy are part and parcel of that joint facility.
Yeah.
We expect that Jimmy will guide Jubril, Jubril will guide Jimmy, and lending to groups is one very positive area we see as banks in the market, because peer pressure would actually support Jubril to repay in case he starts developing that perception or that idea of not repaying. But because Jimmy knows that if Jubril doesn't pay, it also affects his own profile, Jimmy would ensure that Jubril pays.
Yeah.
So I would say today, we are encouraging group lending more, because that would assist in ensuring that the strength of repayment becomes better.
All right.
Yes,
And
please.
just speaking about the role of financial literacy and looking at a market like Kenya, does it then improve financial inclusion, or does that then make people more hesitant to get credit?
No, very, very critical. The Kenyan environment, or the Kenyan population, has close to 70% is made up of close to 70% of very young individuals and upcoming professionals. It's how much you know that says how well you can take decisions and give you ability to practice what you intend to do. So for us as banks, our responsibility is to continue to share knowledge, develop capacity, upskill individuals in the market. Kenya is also made up, and Africa, not just Kenya,
Yeah.
is significantly made up of SMEs. Guaranty Trust Bank is focused on deploying financial literacy structures and platforms through which we can guide Kenyans and Africans as a whole
Yeah.
on how better they can manage
Yeah.
their financial
Sorry about that.
expectations. No, that's fine.
Unfortunately, these are the realities of live
Yes,
sessions, and
yes,
there's absolutely nothing you can do. So
yes.
you will bear with us. For those of us who are following this conversation, these are some of the challenges with reality and live broadcast, that some of these things happen.
Yes.
And Jubril, so let's take some questions from X. And we have Eric who's asking on X,
Yes.
does it mean that if I have defaulted on a loan before, I can still borrow under Kesonia?
Yes, Kesonia is just a pricing model. Kesonia is not a borrowing platform. What Kesonia is bringing to the table
Yeah.
is a transparent pricing model that is significantly tied to your risk profile. So if you have defaulted before, your risk rating would not be as strong. as an individual that has not defaulted before.
Yeah.
And what that means under Kesonia is that you would have to pay a slightly higher interest rate based on your risk profile.
All right.
But in terms of you being able to access a facility, you will still be able to access facilities. However, the structures and conditions might be slightly more stringent and the pricing will be much higher than that of someone that has a very positive risk profile.
All right, Eric, there you have it. And also we have Wagner on X who's asking, how can I ensure I don't default on my loan?
Well, not defaulting on your loan starts with you. And that takes me back to the C's of credit.
Yeah.
Character, character, character. You have taken a loan and you do know you have a repayment on a monthly basis. It becomes an obligation. It is your responsibility to think ahead of your repayment dates. If repayment is due on the 26th of every month, ensure by the 24th you have the funds for the repayment in your account. Secondly, don't take loans beyond your capacity. Only take loans that are going to also add value to you. A lot of the loans we take as individuals, we apply them on assets or on expectations that will not improve our capacity to repay the loan.
Yeah.
Please be careful with such loans. Only take loans that will improve your capacity and cash flow to be able to repay a loan. So it's adding value to you. And in terms of you also being committed to the transaction, check the conditions, be clear that the conditions are properly discussed and you understand what you're going into before going into it.
Yeah.
And please commit a part of your own cash flows and savings to that transaction. The lower your interest amount, the higher the probability of repayment and not defaulting.
All right, so talk to us about Campari and how does that, how it works.
Sorry,
There
please.
is Campari, which is a framework that I believe banks use, where we have C is for character, mostly that is the credit score, criminal history, reference from employer organizations, etc.
Oh, okay. Well, that just speaks to your pricing model or your risk rating model. Like I mentioned earlier, every bank that runs its business objectively and professionally
Yeah.
will tie its risk pricing and its decision to actually take on a risk to a risk rating model. And that model speaks to you as an individual, who is your employer, and I'm speaking as an individual to a borrower that is an individual now.
Yeah.
Who are you? What do you do? What's your source of earnings? How much can we see as consistent inflows from you over a period of time? Who is your employer? What type of contract do you have? Is your employer committed to supporting your risk rating at point of you accessing a loan? If you are my employee and at the time you're engaging a bank, I'm willing to write a letter to say, oh, Jimmy is my employee. He's been with me for the last 10 years. He has a very good record in the institution. That gives you some positive notch
Yeah.
to your risk rating, and that will give you better pricing. But if you look at it on the corporate side, one advice, very strong advice I will give to companies and corporate entities in the market, age is a very critical criteria in the course of trying to look at the long-term sustainability of a company. But one very important thing that companies should also ensure is that your financial profile speaks to your age. Oh, I've been in the market for 40 years. I'm a very strong player. But when your financials are dropped into a model, the numbers you have been excuse me.
Sorry about that.
Yes, please. The numbers you've been declaring in terms of audited numbers do not align with your 40-year profile. And therefore, when those numbers are put into a risk rating model, rather than you coming up as a risk rating 1 or 2, based on the fact that you've been in the market for 40 years, You have a very positive record in the market, but your financial records are aligned with a company that has just operated for 10 years, that drops your risk rating.
Yeah.
And the moment you can't get yourself into that very high and strong risk rating positions, then the probability of getting the expected lower rates, lending to me without collateral, becomes quite difficult, because Jubril is the CEO of Guaranty Trust Bank today. Jubril's decision should be tied to an objective and a professional tool
Yeah.
within the institution. Tomorrow, the CEO becomes Jimmy. Jimmy should also be guided by that same objective tool. So my advice is, and that tool is what brings objectivity, professionalism to the table, because it takes away subjectivity from decision making in a bank and ties most of it to objectivity.
All right, and just a quick reminder for all our audience that are following this conversation online, keep on sending your questions. We will try to answer as many of them as we can. And for those that we will not be able to answer at this during this sitting, we will try to get you answers either from Kenya Bank Association or from specific banks such as GTBank here. And we have Angie from X who's also asking, do I have to take a loan or do I just save for to achieve my dreams?
Okay, thank you very much, Angie, for your question. I would say do both. If you earn 1,000 bob today, please save 100 bob of it. If you don't do that, the day you earn 10 million shillings, you would not save 1 million of it.
Yeah.
So please save, and Guaranty Trust has several products out there in the market across various demographics that encourages you to save, and you can leverage that as you try to plan some other things in life. And as you set goals for yourself, start saving towards it, because the moment you do that, achieving that goal becomes the success, the ability to achieve that goal becomes much higher.
Yeah.
However, in life, you can't move from point A to point B just with your savings alone. At some point, you need to leverage the credit profile you have built. You need to leverage opportunities in the market, and opportunities don't come every day.
Yeah.
So when opportunities show up, if your savings can't take you there, please leverage the credit profile you have built, leverage the capacity you have, and that would support you to get into the next level. So my response is, please save, but also borrow when need be, in order to ensure that you can achieve higher goals that you've set for yourself. And as you take the loan, please repay. Because if a loan takes you from point X to Y,
Yeah.
the day you want to move from Y to Z, that profile is your first point of call. Thank you.
All right, so Jubril, two final questions before I give you an opportunity to wrap up. And just like that, guys, our time is almost up. And I know it feels like it has been 5 minutes, but that is the beauty of these conversations. We cannot exhaust them in one sitting. That's why we're doing this series for the next 5 weeks. So make sure to stay tuned, follow these conversations. And if you have any questions, please share them with us and we will be putting them to the right people. So two final questions from me. One of them is for a borrower who's contemplating to get a credit. What advice would you give them? And number two, what is the cost of not having a good credit history?
Okay, so I'll take the first one, the advice I will give to a borrower.
Yeah.
The first thing is ensure that what you want to take a loan for would add value to you as an individual or a company, and it will help you strengthen your capacity to becoming a greater individual or a greater company tomorrow. Don't just take a loan because your friend has taken a loan, or don't take a loan because you need a car, and rather than buying a basic car,
Yeah.
you decide to buy a BMW. Why take a loan to buy a BMW? You should buy a BMW from savings and the fact that you have arrived as an individual. So please only take loans to support basic needs and growth that will impact your cash flow. And ensure that you can repay that loan if push comes to shove tomorrow, and your capacity today is not as strong as it is, which is why don't over leverage and only take loans within the capacity of your repayment. Your second question is around
What is the cost of having a bad credit?
the cost of having a bad credit.
Yeah.
Cost of having a bad credit is going to deny you or make it more difficult for you to access credit going into the future. So please, like I mentioned earlier, there is no perfect transaction. The day you're starting off a transaction, there's factors on the table, which is what guides that decision. But as you move on, macroeconomic conditions change. We all experience unanticipated situations like COVID. Maybe you lose your job. Please come to the table as quickly as possible to discuss with your bank. And when push comes to shove, please put assets that you have on the table in order to get the buy-in of the bank to give you opportunity to restructure. And the moment you restructure, that says there's an opportunity tomorrow to still access credit because you work out the loan and repay, then the possibility of you accessing credit in the future remains very high.
All right, there you have it. But now, before we close, Jubril, I just want to give you an opportunity to make your closing remarks, and then we'll wrap it up.
Thank you very much, Jimmy. It's been a pleasure to be here. Like you introduced at the beginning, my name is Jubril Adeniji. I work for Guaranty Trust Holding Company. I'm the managing director of Guaranty Trust Bank Kenya Limited, a full-fledged subsidiary of the holding company. And we try to refer to ourselves as proudly African, truly international. We are a 35-year-old institution that started off greenfield, and no single shareholder owns 5% of the institution today. The institution is listed on the London Stock Exchange and the Nigerian Stock Exchange, has 2 case studies on it, one by the Harvard Business School and the second one by the Cranfield Business School. We proudly say that we try to build Africans into professionals. We pick you up as a very young individual. In Guaranty Trust, we don't believe anyone is too young. We believe if we support ourselves as Africans, the future remains very bright. In Guaranty Trust Bank Kenya, we are present in we have 9 locations in Kenya, 5 in Nairobi, 4 in Nanyuki, Mombasa, Nakuru, and Thika. Across the East African region, we're in Kenya, Rwanda, Uganda, and Tanzania. In Africa, we're in 11 countries. We're setting up Senegal any moment soon. That makes it 12. Please come to Guaranty Trust Bank. We remain that institution that will listen to you and will give you the guidance you need. We may not give you everything you ask for, but I'm sure as you partner with us and you walk into the future, you realize that the partnership and the advice we'll give has been very objective in the course of the relationship. So Kenya Bankers Association, it's a pleasure to have been given an opportunity to speak to Kenyans today, and we look forward to impacting the growth of Kenya together. Jimmy, thank you very much. It's been a pleasure, and thanks for having me. Look forward to greater conversations in the future.
And
thank
absolutely, and we will definitely do that. Jubril, thanks so much for making time to be here with us and for bracing the cold and the dramas that come with live broadcast. But thank you.
It's a pleasure.
Yeah, thank
it's
you.
A pleasure.
We've really enjoyed this conversation, and we absolutely look forward to many, many more of credit and other issues that are currently affecting our financial markets and our financial sector, and we'll be here to make sure that we answer all those questions that we have. We've told you this is a conversation that will be going on for the next 5 weeks. Remember, the hashtag to use is the CEO Chats at Kenya Bankers at Jim Cario. That's all the time we have for you today. Do join us next week, same time, right here.
Thank you. It's a pleasure. Thank you.